So, if I offered you £1 today, or £1 in a year's time, well, which one would you take? Now, there is an answer to that question. You ought really to take the pound now. And the reason is twofold. Number one, I might not pay you in a year's time. And number two, even if I do pay you in a year's time, you still ought to take the pound now. And that's because normally you could expect to invest the pound you receive today, earn yourself, let's say, 10p of interest, and in 12 months' time, you'd have £1 10p. So why would you not take £1 off me now, earn yourself a bit of interest, rather than waiting a year and taking just £1 in a year's time? Okay, so far, so straightforward. But actually what I've just described is crucial to just about everything in finance to do with valuation, whether it's valuing a bond or valuing a share. This concept, the time value of money, the fact that a pound now is worth more to you than a pound in a year's time, because you can invest the money that you receive now to generate a return over the intervening period. That's actually fairly crucial to investing. Okay, going to turn to a quote now from a guy who knows his stuff. He's called Fred Wilson, and he's a venture capitalist expert, particularly in technology stocks, over in New York. And here's what he's got to say about time value of money, just to show you straight away how this stuff can be applied. He says companies are worth the net present value of their future cash flows. Yeah, that sounds a bit ghastly. Said another way, says Fred, like the sound of that, if you knew that a company was going to earn $1 million a year for the next 10 years and then be shut down, there is no way you'd pay more than 10 million for it, and certainly you'd pay something a bit less than that. Right, that's Fred talking about valuing internet stocks. What does he mean? All right, let's take those words and I'll just explain to you how important this time value of money concept is. First of all, if a company is going to generate $1 million for, let's say, 10 years, okay, why would you pay a maximum of 10 million for it? And secondly, why would you not actually pay the full 10 million? All right, so let's take a look at that now as a way of applying this time value of money concept. This idea that it matters when you receive or pay cash in terms of the value of those receipts and payments. Right, here we go. Now, if I was going to do 10 years, you get a bit bored in the middle. Okay, so I'm going to cut this example down. I'm going to take Fred's principles and say what we're looking at is an investment, okay, that's going to pay us $10 million, let's say, every year for the next 5 years, not 10. Okay, so what would that look like? Well, we'd be sort of saying, well, how much do I need to invest now in order to get the following 5 cash flows, right, received at the end of each of the next 5 years. And we'll keep the numbers nice and simple. This is a beginner's guide, so we'll say that in dollars or sterling, 10 million, 10 million, 10 million, 10 million, and 10 million. All right, now you might be looking at this and thinking, well, that's easy. If someone's going to give me 50 million in total, at some point, presumably I've got to pay 50 million to get it. Otherwise, they're a charity, all right? So the present value of those 5 payments received in the future is presumably £50 million. Or put it another way, you should be equally happy to basically either receive 50 million now or receive 5 payments of 10 million, right? Or you'd invest 50 million to get 5 payments of 10 million. But here's the trick. That makes 2 big assumptions. Number one, all of these 10 millions are going to come in. You're not going to have a default somewhere along the line. And secondly, that interest rates are 0. Because, here's the trick, if in fact interest rates are 5%, okay, here's the problem. If interest rates are 5%, all right, then by waiting 1 year to receive 10 million, you're losing out on the opportunity, if you like, to have that money in the bank now. All right, if you wait 5 years to get a 10 million inflow, you're losing 5 years worth of interest potentially. So there's a problem. Time value of money says that 10 million actually isn't worth as much as this 10 million, okay? Because if you're waiting 5 years to receive a cash inflow, you're losing out on interest in the meantime. Rather have the money now and stick it in the bank and start earning interest. Okay, so how do we deal with that? All right, and the answer is we need to reduce the value of these future payments received at different points in time. How are we going to do that? Okay, this is not a video on the detailed numbers, nitty-gritty of what's called discounting. Okay, but let's do the basic principles here, and I'll refer you to a couple of others at the end. Right, so what you do is this. Mathematically, you do something like this. You would say, right, I'm going to reduce the payment received in 1 year's time by 5%. All right, why? Because basically, I'd rather have the money today. The fact I haven't got it today means I need to look at the value of that 10 million and reduce it by 5% over 1 year. And the way you do that, by the way, mathematically, this isn't a maths video, but the way you do that is to divide it by 1.05, or 1 plus the interest rate. Again, that'll make it a bit smaller. How do you deal with 10 million received in 2 years? What's that worth today? Okay, if interest rates were 0, you can make a case for saying it's worth 10 million today. They're not, they're 5%. So by waiting, you're losing out on 5% in year 1, and you're losing out on 5% again in year 2, because you could be clocking up interest all that time. So what we're going to do is reduce that by twice 1.05. And the way you do that mathematically is you do 1.05 times 1.05, or a little bit quicker, 1.05 squared. Okay? So if you're lost on the maths, don't worry, there are 1 or 2 other videos out there that will help, but I'm going to reduce that by 1.05 squared. Probably get the hang of this now. I'm going to reduce that by 1.05 cubed. By the way, that just means by 1.05 times 1.05 times 1.05. It gets quicker just to say 1.05 cubed. Okay. This for year 4 by 1.05 to the power of 4, and this by 1.05 to the power of 5, which is, if you're doing it longhand on a calculator, 1.05 times 1.05 times 1.05 times 1.05 times 1.05. All right, which is a bit of a mouthful, so we just say 1.05, if you like, 5 times in a row, or to the power of 5. And what does that do? Well, on the example I prepared earlier, as they say, all right, that 1.05 will reduce 10 million received in 1 year's time to around 9.52 million. Okay, 1.05 times 1.05 is the equivalent of 1.103. That's just multiplying 1.05 by itself. Divide 10 million by 1.103, or 1.05 times itself, and you'll reduce that second 10 million to around 9.07 million. Probably see where this is going. In the calculator, do 1.05 times 1.05 times 1.05. Okay, the number you will get is 1.158. So we need to divide the third year's cash inflow by 1.158, and that will reduce it to around, I'm rounding here slightly, 8.64 million. All right, I'll keep going now. So that equates to dividing by, again, a little bit of rounding, 1.216 to reduce the fourth year's cash inflow to around 8.22 million. And finally, bet you're glad I didn't do 40 years now, the final one, that equates, if you bash it out on the calculator, to dividing by 276, quite a few numbers going on here, and that would give you a number of 7.84 million. That, by the way, is dividing the original 10 million by that number, gives you that. Right, phew. Right, where have we got to? Okay. For anyone out there who's still awake, what you do now is add all of those numbers up. All right, to go back to what Fred said earlier, basically, these are the present values of those cash flows if interest rates are a constant 5% over that 5-year period. All right, so just translating that first line from Fred there. Add those all up, and I reckon you get 43.29 million pounds or dollars, whatever it happens to be. Now, that is less, ta-da, than 50 million, which is in theory what you would have paid if interest rates had been 0. So, to go back to Fred Wilson's point, okay, remember what he said was if a company was going to generate 10 million and then go bust, 4 or 5 years, okay, the most you would ever pay, in my example, is 50 million for it. but he actually said you'd certainly pay something less. And the something less in my example is 43.29 million. Why? Because the effect of interest over time is to reduce each one of these payments to a little bit less and reduce the overall value of those 5 payments taken together. So to answer my original question, what would I invest now to get those cash flows? The answer is no more than 43.29 million. Now, before I wrap up, there'll be questions sort of coming screaming at me through the ether, if you like, and I'll just deal with one big one. How on earth did I know to use 5%? Why not 10%? Why not 20? Why not 0? All right, where did I get 5% from? Well, the answer is I made it up, okay? Now, in another video, I deal in a bit more detail with how you make it up, but let's think about what it represents, okay? What we're saying is that if I expect the lost opportunity, so in other words, if I could put money in the bank and earn 5%, all right, maybe I wouldn't invest in this company. So what do I need to do to the value of these cash flows, okay, to make the amount I would invest comparable, if you like, to sticking the money in the bank? And the answer at a rate of 5% is 43.29 million, okay? Or put it another way, if I put 43.29 million in the bank now, right now, at 5%, it should compound up, ignoring rounding errors, to around 50 million over 5 years. All right, so that's point number one. Point number two, in other words, what I'm saying is I need to look at the kind of minimum return I'd expect to get for taking the risk of investing in whatever this company is, and that's going to reduce the value of its cash flows. And the other problem, of course, is that you could get a default. Well, we said it's not going to go bust until the end of year 5, but in practice, of course, companies can go bust quicker than that. All right, so maybe I need to reduce the value of these cash flows even further and bump up this, as they call it, discount rate a bit higher to reflect risk. And here's the rule of thumb: the riskier an investment, the more you reduce its future cash flows, because the more uncertain you are about them. Okay, so the riskier an investment, the higher this 5% is likely to be. All right. So, in summary, covered quite a lot of ground in this video. Time value of money is central to investing. It's a very useful tool when it comes to comparing investment opportunities and valuing things like companies. Okay, it recognises that £1 today is worth more than £1 in a year's time or £1 in 5 years' time. All right. So the name of the game is to identify a rate that you're going to reduce future cash flows by, so that you are comparing apples with apples. In other words, you are reducing these cash flows more than those, more than those, more than those, more than those, so that in time value terms you're comparing like for like. And that's the route to conquering Fred Wilson's comment that essentially you would pay less for a company than the value of its 5 cash flows, and how much is driven by this thing that we call the discount rate. And for anyone looking for a little bit more on where that discount rate comes from, maybe take a look at my video, okay, why the Citi's pricing model is bust, and that covers one of the ways that Citi analysts try and come up with this discount rate, called the capital asset pricing model. For anyone else, okay, I suggest that you tune out at this point, because that video requires a little bit more knowledge of discounting and compounding.